Finance first, freedom follows. Welcome back to Finc Freedom. Have you ever saved up a bit of money and wondered, what's the best way to make this grow? Or felt overwhelmed by all the investment options out there, wondering whether you should buy Bitcoins, Apple, or Tesla stocks? Well, you're not alone. That's why we've created this ultimate guide to investing for beginners. Whether you've got a few dollars or a few thousand, we're here to demystify the world of investing, address common fears, and give you the tools to start your journey. Let's get started. Part 1, the basics of investing. First off, let's talk about why we invest. Imagine you've saved $1,000. You could keep this under your mattress or in a regular bank account. But there's a silent factor at play here called inflation. Think of inflation like an invisible tax on your money sitting still. Over time, it decreases your money's purchasing power. Today's $1,000 might be worth only $950 in real terms next year. This is where investing comes in. By investing, you're essentially putting your money to work, aiming for it to grow faster than inflation is eating away at it. But how? There are so many ways to invest: stocks, bonds, real estate, crypto, and so on. But don't worry, you don't need to be an expert in all these areas. Understanding just a few basic concepts can get you started. Let's break down a few terms. Stocks or shares let you own a part of a company. When you buy a company's stock, you're buying a small piece of that company. The stock's value goes up or down based on how well the company is doing. If the company earns profits, the stock value usually increases. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ, with their prices fluctuating based on market demand. While investing in stocks can offer high returns, it's also risky. Stock values can change rapidly, and profits aren't guaranteed, unlike safer options like bonds. Bonds are like loans investors give to companies or governments in exchange for regular interest payments. When you buy a bond, you're lending money and earning interest on it, usually at a fixed rate. At the bond's end, known as its maturity, you get back the initial amount you lent. Bonds come in various types like government bonds, municipal bonds, or corporate bonds. They're generally safer than stocks, with government bonds being the safest. The risk level, however, depends on who's issuing the bond. A stable government is usually a low-risk lender, while companies can vary. A mutual fund gathers money from many investors to invest in a mix of stocks, bonds, or other assets. This mix, managed by professionals, helps spread out risk. If one investment falls, others might do well, balancing the impact. There are various kinds of mutual funds, like fixed income funds or index funds. While mutual funds offer expert management and diversification, they do charge fees, which can affect your investment returns. Index funds are a type of mutual fund that mimic popular market indexes like the S&P 500 or NASDAQ. Instead of trying to beat the market with active management, index funds take a passive approach, copying the index's performance. This leads to lower fees than actively managed funds. The goal of an index fund is not to outdo the market, but to match it. And often they've shown returns similar to or even better than active funds over time. All these investment options come with their own advantages and drawbacks, yet they share a common potential for growing your money over time. The secret lies in beginning early and making consistent investments. Generally, the most effective way to approach investing is with a long-term view. While short-term market changes can be disconcerting, maintaining patience and a long-term focus tends to lead to more favorable outcomes. Part 2, stocks and shares. When we talk about investing in stocks, we're talking about buying a small piece of a company. If the company's value grows, so does the value of your share. It's like owning a tiny slice of a big pie that can potentially get bigger over time. Imagine you're at a buffet. You wouldn't fill your plate with just one dish, right? You'd try a little bit of everything. That's diversification in investing. By spreading your investments across different companies and industries, you reduce the risk of one bad apple spoiling your entire investment. Some stocks also pay dividends. Think of it as a reward that companies give their shareholders, a share of their profits. Not all stocks offer dividends, but those that do can provide a regular income stream alongside the potential growth of your investment. To buy stocks, you need a brokerage account. There are many online brokers to choose from, each with different features, fees, and investment options. Look for low fees, ease of use, and the availability of educational resources. Some popular options include TD Ameritrade, E-Trade, Robinhood, and Fidelity. Stocks and shares can be exciting, but remember, they also come with risk. The value can go up and down. It's all about finding a balance that suits your goals and comfort level. If you're a beginner, it's wise to start with a small investment to get a feel for the market. Many online brokers offer fractional shares, allowing you to buy portions of a stock, which can be useful if you're starting with a small amount of capital. Do your research and don't put all your money into one stock or one sector. Spread your investments across different companies and industries to mitigate risk. Alternatively, you can invest in low-cost index funds, which offer diversification and lower risk compared to individual stocks. Part 3. Addressing common fears. A big question we often hear is, what if I lose all my money? This is a valid concern. Investing does carry risks, but there are ways to manage them. One key strategy is diversification, which we touched on earlier. Another is to invest only what you can afford to be without in the short term. And remember, investing is a marathon, not a sprint. Patience and consistency are your allies. Another common fear is, what if a global recession hits our economy? Recessions are part of the reasons why stock market is volatile. Economic cycles are a natural part of the economy. A diversified portfolio can weather downturns. Historically, markets have recovered and grown over time. Remember, it's not about timing the market, but about time in the market. Feeling a bit more at ease? Great! It's normal to have fears when you're new to investing. Taking the time to understand the stock market and creating a well-thought-out investment plan can help alleviate these fears. If you have more fears or concerns, please feel free to drop on the comment section below. Part 4. Fast Lane Investing. This section is tailored for those who are ready to embrace higher risks for the potential of higher returns. Remember, fast lane investing is not about chasing trends recklessly. It's about making strategic, informed decisions in areas like real estate, cryptocurrency, and entrepreneurship. Think of Warren Buffett's calculated investment moves or Elon Musk's bold ventures. It's all about playing smart with high stakes. In our exploration of fast lane investing, the first avenue we navigate is real estate investing. This can range from purchasing rental properties to investing in real estate investment trusts, known as REITs. Real estate stands out for its dual earning potential: steady rental income and the possibility of property value appreciation. It's a tangible asset, offering a sense of control and security, much like the impressive portfolio of Barbara Corcoran, who turned a $1,000 loan into a billion-dollar real estate empire. However, the entry into this realm often comes with high upfront costs and demands ongoing management. Market fluctuations, as witnessed in 2023, with significant rent decreases in states like Oregon, Georgia, and Florida, can impact both property values and rental incomes. This unpredictability echoes the challenges faced by Donald Trump, whose real estate ventures have seen both towering successes and steep declines. Thus, a deep understanding of the local real estate market becomes essential. Investigating property prices, assessing rental demand, and staying abreast of area development plans are key steps. As emphasized by successful investors like Grant Cardone, knowledge of market trends and regional dynamics can be as valuable as the property itself. For those less inclined towards active property management, REITs present an appealing alternative. REITs allow you to invest in real estate portfolios without the complexities of managing the properties yourself. This approach provides exposure to real estate's lucrative aspects while sparing you the day-to-day responsibilities of property management. Now let's talk about cryptocurrency. It's a digital revolution in the form of virtual money, secured by cryptography and operating beyond the realm of central banks. Cryptocurrencies have captured the world's attention, not least for their extraordinary growth potential, as seen in Bitcoin's meteoric rise, which turned early adopters like the Winklevoss twins into billionaires. They stand as a testament to the power of decentralized finance, offering an autonomy that traditional financial systems can't match. Some even view them as a hedge against conventional market fluctuations, similar to how gold has been perceived historically. However, the world of crypto is akin to the Wild West. It's a landscape of high volatility and unpredictability. The market is prone to dramatic swings, heavily influenced by regulatory shifts and technological advancements, much like Elon Musk's tweets that have swayed Bitcoin prices. Navigating this domain requires more than just a passing interest. It demands rigorous research and a strong grasp of blockchain technology. Consider the approach of someone like Michael Saylor, the CEO of MicroStrategy, who made a substantial investment in Bitcoin after an exhaustive analysis of its potential. When considering cryptocurrency for your portfolio, the key is moderation. Limit your exposure to a sizable yet manageable portion of your assets. Be prepared for a roller coaster ride of ups and downs. The volatility is part of the package, and it's not for the faint-hearted. And remember, while stories of overnight crypto millionaires are alluring, it's crucial to invest based on sound understanding rather than getting swept up in the hype and speculation that often surrounds digital currencies. Finally, we turn to what could be considered the pinnacle of fast lane investing: starting your own business. This is where you channel your vision and skills into a venture that's entirely your own. Think of it as planting a seed that you nurture into a flourishing tree. The potential is truly boundless. The satisfaction of building a company from scratch, much like Steve Jobs or Sarah Blakely did with their groundbreaking ideas, can be immensely rewarding. You're not just creating a business, you're bringing a personal vision to life, shaping it with your unique insights and determination. However, this path isn't without its challenges. It demands more than just capital. It requires your time, effort, and unwavering commitment. Remember, even titans like Jeff Bezos and Mark Zuckerberg faced significant hurdles in their early days. The reality is many new ventures struggle to reach profitability. It's a journey filled with obstacles and learning curves. So, how do you set off on this path? Start by laying a solid foundation with a comprehensive business plan. Conduct thorough market research, understand your target audience, and develop realistic financial projections. Your roadmap should be as detailed and clear as Elon Musk's vision for SpaceX. Embrace the concept of a minimal viable product, a strategy famously used by tech startups in Silicon Valley. This approach allows you to test your idea in the real market with a basic version of your product or service. It minimizes your initial investment and provides invaluable feedback for refinement. It's about starting small and being agile, ready to adapt and evolve based on real-world experiences and customer feedback. Embarking on the journey of starting your own business is an adventure that requires courage, resilience, and strategic planning. But for those who are prepared, the rewards can be extraordinary, not just financially, but in the fulfillment of seeing your vision come to life. Fast lane investing offers exciting opportunities, but requires careful planning, thorough research, and an appetite for risk. Whether it's investing in the real estate market, buying cryptocurrencies, or launching your own venture, the key lies in informed decision-making and strategic risk management. Remember, diversification is crucial, even in fast lane investing, helping balance potential high-risk ventures with more stable investments. And with that, we wrap up our ultimate guide to investing for beginners. It's been an insightful journey where we've unraveled the essentials of investing, navigated through the complexities of stocks and shares, addressed those common investment fears, and even ventured into the exhilarating fast lane of investing. But remember, the path to investment success is as individual as you are. Start with small steps, embrace continuous learning, and choose the investment path that aligns best with your personal goals and comfort level. Keep working towards your financial goals and be kind to the others. Thanks for watching, and don't forget to like, subscribe, and share your thoughts in the comments below. See you in the next video.